Howdy, Jacob here. Today we're looking at WPP. Some of the financials we see, it's in the media industry on $10.7 billion market cap, $13.7 billion enterprise value. So about $3 billion net debt here. Return on invested capital appears to be low single digits, mid single digits. 5.1% dividend yield. Let's look at that balance sheet. Balance sheet's long-term debt and short-term debt accumulates for about six billion, and their cash on hand is 3 billion. So only 3 billion net debt, which is not terrible to see, especially when your 5-year average free cash flow is probably about 1.6 billion. And 1.6 billion compared to their dividend payout is probably 30%, so relatively cheap. Looks like their use of cash has been making acquisitions, paying down debt, and paying down their stocks. So stock repurchases recently. It looks like they've been buying back shares very consistently, and then debt they've been buying back a little bit recently, but looks like they've stayed relatively flat throughout the last 10 years, and then making acquisitions. They also use quite a bit of cash consistently on making acquisitions. And so, although they do make acquisitions, their growth has actually declined on revenue from 2013 of $18.1 billion down to $17.6 billion in revenue 10 years later. I think I'm ready to start making some assumptions here. I'll say that maybe it's a low growth business, -1, and then even with acquisitions, they're not growing. And so organically, they're really not growing, which is forcing me to put them at a very conservative P and price free cash flow. They do buy back shares. So let's say they buy back 2% of shares with their free cash flow. Looks like they're also using a lot for um, acquisitions. I think I'm fine keeping their dividend as is. They've paid a dividend very consistently, but the actual dividend has very sporadically moved up and down. So I think I'm good keeping it as is. As for margins, it looks like free cash flow is a little bit higher, but I'll go pretty close to historical averages here. And through those estimations, we get a stock price that needs to fall about 43% before you get a 15% return. Given these assumptions, I would say that, again, no growth businesses or negative growth businesses can still be valued at something. I mean, if I did a further review and these were my final assumptions, where it's declining 1% a year and margins are not fantastic or anything, and it was selling for $10 a share, then it would sound like an absolute screaming deal. And so just remember, when you evaluate stock companies, it's not the company necessarily you buy, but the price that you buy it, that is honestly the most important factor. And so to me, this dividend yield of 5.1% seems pretty reasonable for them. And their balance sheet is not super terrible. Yeah, it might be a declining business, but even a declining business has value to it. And so for me, I would definitely add this to a dividend yield list, but to me, it's just a little bit out of my price range at this moment. I want it to buy when it's stupendously cheap, especially for a business that's declining. So hopefully everyone enjoys the video and has a great rest of the day. Thank you.